The following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And here we are, Saturday. It's KFLE, The Answer. So we must be the answer about money. And you've heard the expression, you know how you make money in stocks. It's pretty simple. It's straightforward. It's simply buy low, sell high, right? That's pretty standard. People know that. I mean, it's not difficult. Buy low, sell high. But you know what? Most people don't do that. In the fourth quarter of last year, as we were coming up, the market had been zooming upward for the first three quarters, and then in August, the end of August, the beginning of September, things began to peak and roll over. And in the fourth quarter, all the gains for 2018 disappeared, and the Standard & Poor's, for example, ended up down 4.5%, counting dividends. Counting it all in, minus 4%. And during the fourth quarter, there was a big outflow of people taking their money out of mutual funds. Where did it go? Not into stocks. In the first quarter, $120 billion of it went into bonds. $126 billion more during the first quarter flowed out of stocks. And $35 billion of that went into ETFs. But $102 billion flowed into corporate credit funds. So we have a stock market where it's in recovery and money is still moving out. We have a stock market where the prices are low and people are selling, continuing to sell. The old adage, buy low, sell high. Most people are buy high, sell low. The problem, as things look forward and people were painting a negative picture and people were saying the stock market is going down during the fourth quarter, so it must mean the economy is going to do terrible, earnings are going to be terrible. You've got to sell your stocks and move into bonds, and so what happens? People sell out. And, here we are. The market generally recovers, according to Dalbar, recovers 65% of the down in the first 30 days following the down period of time. Now that's a fairly recent number because work was done at the New York University in Albany, or the University of New York in Albany, where they found that it took about 90 days for a market to recover from a recession downturn. But from a normal correction, and we probably had a normal correction in the fourth quarter, it takes just 1 month to recover 65% and 2 months to recover 85%. And we're right on schedule with what's going on. What we had in 2018 was essentially, when you look at the beginning of the year and the end of the year, almost a flat market. And I haven't seen something like that since 1995. 24 years ago. During that time, think of all that's gone down, and the stocks were down in 95, 2%. In 2018, down 4.5%. But think of all the concerns. The concerns, back then there was $20 billion that had flowed out of stock mutual funds. Hedge funds were losing billions. Same was true of 2018. Hedge funds were losing. Hedge funds that were supposed to be set up to mitigate losses were actually losing money. Private equity in 1995 was struggling. In 2018, private equity was struggling. 1995, you had China on the rise. Guess what? We had questions in 2018 about China and what was going on. 1995, we were seeing the problems crop up in the emerging nations. The Southwest Tigers were the countries like Thailand and Indonesia. Those countries, the Southeast Tigers, were struggling, but they weren't the only ones. Argentina and Russia and the countries in the Middle East, they were all struggling as well. The market was only off 2% in 95, 4.5% in last year. And while history doesn't repeat, it often rhymes. It's a saying that's been attributed to Mark Twain. Nobody knows if he really said it or not, but it's as good to say it came from Mark Twain as anyone else. In 1995, the New York Times, looking at what was going on, came out and said, prepare for a big, deep bear market. 1995. Instead of having a bear market in 95, from that time forward, the Standard & Poor's would increase from 487 to 1366 in those 5 years between 95 and 2000. That's a 280% increase in 5 years. Put it in terms of today. That means that the Standard & Poor's 500, from its current value of 2928, would rise to 8,298 in the year 2024. The Dow, which stands at 26,484, would rise to 74,164. That's 3/4 of the way to 100,000, which I've been saying 100,000 since the year 2010. Listen to more of the concerns. 1995, there was a big concern because Hillary Clinton was doing the health care plan. Orange County was filing for bankruptcy. There was a big question about Orange County and a number of the other counties around and cities around. There was a question about Mexico and their sovereign debt and devaluation of the peso. The issue of China, I mentioned before. Japan was struggling. And if you look at Japan today, their debt is almost twice what their GDP is. That's a struggling nation. That has to come under control. Back in 95, there was a lot of concern. NAFTA had just been passed. There was a whole lot of concern that jobs were suddenly fleeing from the U.S. and going to Mexico. We've dealt with NAFTA this year. It was a market that was already an aging bull market. The market had come from August of 82 from a value of 1,000 to what it stood in 1995. It was aged. It was up 60%. It was up 60%. One of the best-selling books in 95 was called Bankruptcy, 1995. Why the U.S. Will Collapse. 1995. Why the U.S. Will Collapse. Was written by Figel and Swanson. And yes, it was a year that was flat for a year, and it was down during the year. But basically, the good news was it wasn't bad news. There was a fairly large group of negative people that were thinking that the market had peaked. It was old. It was going to fall into disarray. And that was a lot of the pervasive thinking. So, I've been talking for the last few weeks about the Money Show. The Money Show is coming to Seattle. It's going to be here June 15th and 16th. I will be presenting at the Money Show here. I'll be presenting in a couple weeks at the Money Show in Las Vegas. I presented at the Money Show in February in Orlando. And the pervasive attitude or the pervasive thoughts of the speakers in Orlando was that we have a very old bull market, that we have all these concerns. The market was flat last year. We're in for another disaster this year. The idea was sell while the getting is good. The fact is, people rely and respond more to negative news than they do to positive news. A couple years ago at the Money Show, there were people talking about the melt up, and as soon as the Fed quit putting money into the market, things were going to drop off a cliff. Now, people didn't seem to remember what they were saying a couple years before because the market didn't fall off a cliff. The market kept going up. I take notes when I go to these conferences, and I keep track. And I keep track of what the speakers say. And I'm not always right. If someone keeps notes on me, they'll find things that I say that are wrong. That's okay. But to go year after year after year and listen to speakers year after year be wrong, and then to go ahead and believe what they're saying, it's the definition of insanity, right? Doing the same thing the same way and expecting different results. Anyway, all that to say, it's a crazy time out there. It's a beneficial time to be in the market and not out of the market, because all those people that took money out in the fourth quarter, all those people that took money out in the first quarter, they'll be back. They'll be back. That's money sitting on the sideline that's going to come in. We're going to come up to a commercial break here in a very short time. Don't go away. I've got more to say on this. We'll wrap it up. I've got a great guest. You want to hear what he has to say? And we're going to talk about some of the tech giants as well. Don't go away. We've got a lot to cover. Stick with it. We'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about what happened in the fourth quarter, what happened in the first quarter. Money is flowing out of stocks, flowing into bonds, flowing into other investments. That money will be back. It's coming back. Dalbard does a report, and they've been doing a report for a number of years. They now have data going back 30 years. They accumulate the data from the mutual fund companies and the investors in the mutual fund companies, whether they're do-it-yourselfers or whether they're advised by financial advisors, and they look at how investors do. The latest report, which is for the 30 years ended in December 31st, 2018, which means it goes back to 1988, the beginning of 1989, actually, January 1st, 1989 through December 31st, 2018. Is that 30 years? Yeah, that's 30 years. I want to make sure my math is right. I was a mathematician. So anyway, Dalbar, the average equity investor over those 30 years grew their account using mutual funds 4.09%. So if they started with $100,000 on the 1st of January 1989, that $100,000 would have grown to $332,222. Which sounds pretty good. It tripled, right? The market during that time was up 9.97%, the Standard & Poor's 500, 9.97. That means that 100,000 wouldn't have grown to 322. It would have grown to $1.7 million. 6 times, approximately 6 times what it would have been for the average equity investor. And if you can add a couple percent to that, that even works better. Bond investors, on the other hand, average just slightly over 0.25% for 30 years. That meant $100,000 invested in bonds grew to $108,000 over 30 years. If you look at the Barclays Bond Index, it grew at 6.1% or to 590,000. So instead of 108, it grew to 590. So what's going on? People are moving from stocks into bonds, bonds into stocks, and they're picking the worst time. It's Like driving in traffic where you see one lane is going faster than the other, so you switch into the lane that was going faster, only for it to slow down and the lane you got out of now speeds up. So seeing that lane speed up, you think you're going to get back into the lane you started from. You get back into that one, only to see the lane you got out of is going faster. That's what's going on. But consider this. Inflation during that time was going at 2.49%. So $100,000 would have dropped to the equivalent purchasing power of $50,800 and some dollars. Half of the purchasing power of what you owned 30 years ago would have been wiped out. It would cost you twice today what it would have cost in 1989. So an investor who's switching back and forth with bonds and stocks is going to end up not even keeping up with inflation. So that brings to the point of timing the market. There's a whole lot of things. And when you come to the money show in Seattle, you're going to see a lot of booths that are set up to do trading, stock trading, day trading, timing the market. You're going to have people who have models for when to get into and out of the market. There have been a number of studies that have shown. It started with Peter Lynch and John Vanderheiden, who looked at the time from 1981 to 1991, and they said if you just missed the best 10 trading days in those 10 years, an average of 1 day per year, your return dropped from 14% to 4%. The late Jack Bogle, who started Vanguard, said that he has never known anyone, nor has he ever known of anyone who knew someone that outperformed the market over the long term of a trader. The work that Vanderheiden and Peter Lynch did in the early 90s was repeated by KLFE, and most recently, the index fund advisors compiled a report looking at 1998 to 2007, a period of 20 years, 5,036 days. And staying invested during that full time, the Standard & Poor's was up a total from 100,000 to 401,000. In other words, it quadrupled during that time. Missing just 5 days out of 20 years would have reduced the return by 45%. Instead of being 400,000, 100,000 would have grown to 266,000. Missing the best 10 days, 1 day every other year, would have reduced the return by 67%. 100,000 would have grown to 200,000. Missing the best 20 days, an average of 1 day per year, reduced the return by 91%. 91. Think about that. An average of 1 day per year, reduced the return. 100,000 would have only grown to 125. And missing the best 40 days, an average of 2 days per year, would have meant 100,000 would turn into 56,000. Think about that. There's a reason to be invested in the market. Think about an actual example. Prior to Christmas in 2018, for 3 days leading up to Christmas Eve, the market, and including Christmas Eve, the market was down about 1,500 points. There was really no sell point, but there was this whole feeling that the market was on its way down. Now, on December 24th, 665, the market plunged 653 points, the Dow. What happened? You would have had to figure out that the time to buy in was Christmas Eve day to not have gotten the return, or to have gotten the return on the best trading day in history. On December 26th, the day after Christmas, the Dow was up 1,024 points. What changed between December 23rd and December 24th and 26th. What happened in those 36 hours? Nothing. Absolutely nothing. So if you miss just the best 5 days out of 20 years, you cut your return almost in half. Miss the best 40 days and you can end up with a negative return. So yeah, you can do much better if you miss all the bad days, but picking out the bad days and making sure you're in for the good days is a losing proposition. You know, Fama said it, there's very few people that are actually able to achieve a performance which outdoes the market. In 2013, he received the Nobel Prize, or shared the Nobel Prize, showing in his studies that fewer than 7% of money managers actually earn their fees. That means that their net return after all fees and costs is equal to what their benchmark is, equal to the Standard & Poor's 500 if that's what they're measuring. Fewer than 7%. Standard & Poor's study shows that fewer than 5% actually outperform over a period of 10 years. Think about that. You know, the odds of doing it by luck are 1 in 100,000. And yet the reality is there are 5% of money managers who do it. So what's gone on with this whole period of time, the fourth quarter to the first quarter? I believe the old saying is that the market's driven by fear and greed. I think there's a third factor, and that's the fear of looking stupid. You know, back 50 years ago, institutions owned 10% of stocks, New York Stock Exchange stocks. Today it's 95%. But the pressure to perform is incredible. Gary Porter and Jack Triffs reported in the Financial Analyst Journal in August of 2014, they reported that they looked at 1,825 managers who managed stock mutual funds. Of 1,996 mutual funds managed equity mutual funds, there were 1,825 managers. Some managed more than one fund. Only 195 of those managers were still left after 10 years. After 1 year, 19% were gone. After 2 years, another 19% were gone. So over a third were gone in less than 2 years. Third year, 17% were gone. In the fourth year, 12% were gone. 2/3 of the money managers were gone within 4 years. So there's a tremendous incentive to perform, a tremendous incentive. And it's a quarterback performance. And so in brokerage terms, in financial advisor, stockbrokers terms, it's a term called FOMO, F-O-M-O, fear of missing out. That's part of the market. And for an investor over the long term, being in, you can actually take advantage of what's going on. We're coming up to a commercial break very soon. You can hear these programs but by checking us on YouTube. You can also check the podcast on our website. You can also see the performance that I've achieved in helping our clients by checking the performance page of the website. You also get some information by signing up for our e-letter that comes out sometimes weekly, sometimes monthly, sometimes it comes out. Anyway, do that. We're coming right up to a commercial break, and when we come back, you're going to get to hear from my guest. He's got a great story and a vision into the future. Stay with me. We'll be
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Welcome back. And I have a guest who has an interesting background story. We're going to talk about that. Ken Moyle of K6 Partners. Welcome to the program, Ken.
Great to be here.
So why don't we start with your background?
Well, where do I start? I took an unusual route. I think I started out as a salesperson in the business side of things, and when I came up to Seattle, I went into high-tech sales. This was way back in the black and white days of the '80s, and took a turn into the legal profession. And by then, I had been so well connected within the high-tech community that I was able to come right out of law school and work in-house at a company that eventually went public over here in Bellevue, and went from business to business, working for some tech companies that were public, some that were startups, and had the opportunity to be recruited very early on in my career in 2006 to a company called DocuSign, which I'm sure most of your listeners have heard of, but back then nobody had heard of it, I assure you, as their legal counsel. And so my background as a business person, tech person, and lawyer came into play there because the DocuSign product was a legal product. And as I'm fond of saying, when a 26-person startup comes to you and says they want a general counsel, you usually have to ask, well, what did they do wrong? Who's going to jail and when, and what do I need to do? But actually, that's not true. What happened with DocuSign's case is they needed somebody to go out and remove legal and perceptual barriers and policy barriers to adoption of the technology. And so that's where I spent about a decade doing, kind of slaying those dragons.
I want to talk about DocuSign some. DocuSign was on our program very early in the early stages. At that time, they were struggling to get approval.
Yep.
So let's talk about that process, because I think that applies to the rest of what you do, and that also applies to looking forward into how technology changes in the acceptance. So let's talk a little bit about DocuSign, and then we'll move on.
Yeah, there are some things, and of course, K6 Partners. There's a story about where that name comes from, and it's based upon the fact that there are certain rules of technology that really never change, and we think we're in a very rapid adoption period of technology right now, but technology has always been evolving, and there's always the same sort of human characteristics that end up interacting with it in both positive and negative ways as it rolls out and becomes adopted. In the case of DocuSign, because it had to do with electronic signatures and the legal aspect of coming to terms of agreement with somebody, this time online rather than shaking hands over a table and signing with a pen and ink. Even though a law had been passed back in 2000 to give instant credibility to that type of signing, folks were not comfortable with it. And when I say folks, I mean folks in the government, folks in business, and folks in real estate transactions, and you and me and everybody else. We weren't sure if it was legal. We weren't sure if it was going to be authentic, whether it was going to hold up in court. My job was to go out there and win hearts and minds and change people's perception of what the law was and what it wasn't.
And today it's widely accepted.
Today it's ubiquitous, obviously, and there are, as I've been fond of saying, there's probably more security and more veracity to an electronic signature, given all the bells and whistles that are available with it, than there is simply putting it.
And anybody who's purchased a house in the 90s or 80s or before remembers going into the office and a stack of papers that was maybe 3 or 4 inches thick and going sheet by sheet by sheet, initialing and signing and signing and initialing. I mean, and you ended up with 2 inches or 3 inches of paper to take home and stick in a file, which you never again saw.
That's right.
And once you moved, you threw away anyway.
Well, the interesting thing is that if you go through the mortgage process today, you'll go through that exact experience today, 20 years later, because of the problems of getting folks to respond and take part in technology that's clearly to their benefit, but to the extent that it disrupts an ecosystem with a lot of people that have, and industries that have entrenched interest, you'll find a very slow adoption. And the mortgage industry, which was actually the industry behind the Electronic Signature Acts in the first place back in the 90s hasn't gotten there yet. You still have to go through those pieces of paper and go to the title agent and have your notary and have all the pieces of paper FedExed around and things like that. So there's still a long ways to go.
I do know that we did a line of credit with a bank for Adams Financial Concepts. And instead of signing that big packet of papers, it was all electronic.
Yep, that's correct. Yeah.
It's easier, it's faster,
and more secure.
Complete record. You put it in an electronic file. You'll have it as long as you ever need it. And it took 15 minutes.
Absolutely.
It takes longer to read the documents.
And we had to convince for the kind of transaction you're talking about, we had to convince the banks, we had to convince the regulators, we've had to convince the IRS, we've had to convince Fannie Mae in order to accept, electronically signed purchase and sale agreements. That all took some doing, and it all took some, a lot of convincing and a lot of patience to get that done. But that's,
So that brings us to today and talking about blockchains. So let's talk about K6 Partners and what you're doing now.
Great. Well, talk about history not repeating itself, but rhyming, as you did in your earlier segment. When I looked up after 10 years of bringing electronic signatures into the mainstream, I saw a lot of comparisons between what we went through back in the early 2000s with e-signatures to what blockchain is going through now. Some misunderstandings about what it is and what it isn't, some preconceived notions, a lot of threats to those industries that may be getting disrupted, and a lot of challenges. So we started a company called K6 Partners. There's also a law firm called K6 Legal that owns K6 Partners. And we work with startups, we work with larger businesses doing consulting work with anything to do with digital transformation. But we also do work with blockchain startups in particular, and got into the blockchain space because we expected to be able to do the same things for blockchain that we did with e-signatures back in the old days.
So a lot of people know that Bitcoin is a blockchain, but let's take it down and talk about a bank ledger and what happens there, because I think that's a great illustration of what blockchain technology is going to replace.
Well, the key word that you just used there, Mike, was ledger, and the fact that you're talking about a bank is a perfect segue into discussing what the whole point of Bitcoin was and the technology that came out of that and how it's applicable today to things that may not have to do with cryptocurrency. But just to set the stage, and I'm sure most of your listeners are familiar with blockchain, at least they've heard the word. The idea of a cryptocurrency was an idea to say, okay, we have right now a currency system that is based upon trust. It is based upon trust of the issuing party, which is usually a government. In the case of the US dollar, it's the United States Treasury. And we don't obviously or aren't naive enough to think that when we have a bank account, a Bank of America or Wells Fargo or Citi, that we put in a big pile of dollars and there's a big drawer with our dollars in it that we can go out and get to anytime we need to and borrow from it and things like that. No, what we have is a ledger. And the bank, we trust the bank to keep track of how much we have and how much we've given them and how much we transferred out, and to honor the drafts that we make when we write checks. That is why banks have big stone pillars in front of them. That's why banks have, all the trappings of a very trusted, solid institution, because we need to trust them. Imagine having a currency system where that ledger that the bank keeps on your behalf was actually kept public by a community of folks that are all driven by their own self-interest to keep it accurate and keep it updated. That's not to say that not necessarily that they see what you own and how you have it, but that the transactions that you make are properly notated and properly financed. It's called the double spend problem, right? if you don't have a ledger, you can't keep people from spending money that they don't have. How do you do that without a bank? That's what Bitcoin is about. And so Bitcoin was based upon solving that double spend problem without an institution and without requiring a trusted intermediary to take care of it. Now, I know we're coming up on a break here pretty soon, but maybe we can talk a little bit about how outside of cryptocurrency, how the underlying technology, the blockchain, can actually work to help businesses.
Yeah, because what we're seeing, people are familiar with it with the Bitcoin, but the example you used with the bank and the trust, it's a ledger. The blockchain is really a ledger. And like the bank ledger, when somebody goes in and enters a deposit, you go to the teller, you go to the ATM, you do a mobile deposit on your telephone. It goes in, and the ledger doesn't undo itself. It isn't susceptible to being undone. Those ledgers are posted, and the BitChain operates in the same way. We're going to come back after the commercial break and talk about that a little more, because it applies not just to Bitcoin and to banks, it applies to a lot of businesses. Don't go away. We'll be right back. We've got more to discuss. This is new technology. Not available now, but it will be in the future. So you should know about this. That's the idea of this program, is to give you insight into what's going to be happening.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Kim Moyle of K6 Partners. We've been talking about blockchains. It's a technology you need to begin to understand because it will come. I can say back in the 1980s, I didn't understand computers technology. It came. Everybody is involved in it. I was early in the internet in the early 90s doing the internet. Today, almost everybody is using the internet. Blockchains are one of those technologies that is going to be, in the next 10 years, something very significant and a significant change in improving productivity in businesses. So anyway, with that background, back with Ken. Let's talk about blockchain.
Well, before the break, we were talking about ledgers and the fact that banking, transactions require a ledger that is protected from being changed and that people trust is accurate, and that the double spend problem is solved. So that again is how we got Bitcoin. But Bitcoin is one cryptocurrency that bases itself on this technology. This technology now has taken on a life of its own outside of the cryptocurrency space to say, hey, look, if we have a whole business ecosystem, like say the mortgage industry or a supply chain, everybody in that industry, everybody in that supply chain, everybody in that ecosystem keeps their own ledger, pays enormous amounts of money to protect data, to protect their ledger from being hacked, and based upon mistrust of their other trading partners, making sure that they audit each other and that there's regulators that have their noses in all of those ledgers to make sure that they're being correctly done. Billions of dollars is being spent on this very inefficient and ineffective means for conducting business with trading partners. If we had to do it all over today, we would say, well, how about we use a distributed ledger, another word for blockchain. Blockchain simply is a continually growing list of records called blocks that have some characteristics. They're protected by cryptography, and they have a link back to the previous record. And those records are created through what's called a consensus mechanism. That means that rather than having a bank do it, there's a means by which everybody involved in these transactions decides is a good and enforceable way of deciding the next time that a timestamp gets put on a group of records called a block, that is legitimate and that is the source of truth. Deciding on how that consensus mechanism is obtained is one of the roadblocks, one of the problems we have with implementation. But deciding to actually replace the current inefficient system that you have is probably the major stumbling block to adoption. It probably doesn't make sense for one company internally to have its own blockchain on which to keep a ledger. Why? Because you have generally controls in place that you don't need decentralization. You have more or less trusted people all on the same team, versus, again, an industry that has multiple iterations of the same ledger already, but don't trust each other. Imagine if they all trusted the technology that's required to keep the record perfect and had one ledger from which to work. That's the idea of blockchain. That's the idea of the disruptive nature of the technology.
To come back again to the bank, because it's something that I think illustrates the idea very well, is that the bank not only has your ledger, they have mine, they have Joshua's, they have Chad's, they have Alice, they have Mary,
Yep.
They have all those together. And they coordinate between all those to a total. And your money you put dollars in, it gets commingled with somebody else's. And in fact, there's no separate drawer. It's all separate on a ledger.
It's all just digits at this point, right? It's
Yeah.
all, and of course, in your own bank, it's all electronic as well. Dollar bills are very quaint, but ultimately, the commerce is run electronically now.
And so if you have an industry, it can have different companies, different vendors, different suppliers, different sales areas. It's all putting together one single ledger, which everybody can use.
Well, there can be several different ledgers used that that use blockchain technology to actually run themselves on. But if you want to build a ledger that is updated by different members of different trading partners, different stakeholders within the ecosystem, if you can imagine how much more efficient that is. And the only idea is, okay, how do we replace our current system with that ledger, and how do we decide on how if there's competing pieces of data that don't agree with each other, who's right, and which piece of data should get to be made part of the chain, part of the system of truth.
It's an amazing technology. It's the nascence, the very beginning of the technology. I think it's got a tremendous future. I can remember in 1965, as we bring this to an end, I can remember in 1965 seeing the cover of Time magazine with the double helix on it. Watson and Crick had discovered the DNA, the double helix. And I thought to myself, so what? I was dumb and stupid in those days. When you think about the so what today and the manipulation they're making of molecules in the DNA and genes and chromosomes, it's enormous. And I think, what you have with the blockchain is also equally something that's going to be an incredible technology.
Now, and you have to know that this technology is here. There are companies right now that have built blockchains, have built systems on top of blockchains. There are larger players moving into the blockchain space, including IBM, Citi, with their own coins even. And Samsung more recently. So it is here. The proof is in the pudding, of course, as to when we finally find an ecosystem that is willing to replace itself in the way it's currently doing things. That's when it's really going to pay off, and that could be, well, I wouldn't hold my breath. It's not going to be 2020. It's going to be quite a while. There'll be a lot more poking around before we end up with
maybe.
Yeah.
Anyway,
a big splash. Yeah.
Big splash. We're coming up to the end of the show. I do want to remind you that the Money Show is coming in June 15th, 16th. I will be speaking 3 times. I'll be talking about how this secular bull market ends. I'll be talking also about getting superior returns with minimizing risk. I'll be talking, Steve Forbes will be talking I've seen a list of dignitaries, and I've talked about dignitaries. The list continues to change, but I think Edward Iardini will be here. Louis Navalier is supposed to be here. A lot of names. My name is down at the bottom. That's okay. I have more speaking engagements than anyone else. So do come and hear me. I'll be speaking both on Saturday and Sunday. It's too bad that it's on Father's Day. But what better gift can you give a father than to bring him out and hear Mike Adams speak in person? Anyway, coming up to the end, do put June 15th and 16th on the calendar. Do come to the Money Show. There's going to be a lot of good stuff that's said. Hopefully, I'll say a lot of it, but we'll see. Anyway, I'll be doing that. And if you miss any of this show, and if you want to hear more of what Ken has to say, contact him at K6 Partners.
K6partners.com.
Okay. Anyway, that wraps it up for today. Have a good weekend, rest of the weekend, and a good week. And if it's Saturday, I will be back to talk about money. We'll have the answer about money. That's Saturday.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program is for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams.